Welcome to Business Decoded, where we break down how companies really make money. Let's decode today's business model. BlackRock manages $10 trillion. That's more money than the GDP of every country except the United States and China. They vote on behalf of millions of shareholders at every major corporation. They influence executive compensation, board elections, environmental policies, and strategic decisions at Apple, Microsoft, Amazon, Tesla, every company in the S&P 500. Nobody elected them. Shareholders don't vote directly. They give voting power to BlackRock by investing in index funds. BlackRock uses that power to shape corporate America. This creates concentration of power that makes democracy look quaint. BlackRock doesn't just invest your retirement savings. They control how corporations behave. One asset manager influencing thousands of companies affecting billions of people, all while claiming they're passive investors who don't interfere. By the end of this video, you'll understand how BlackRock accumulated $10 trillion in assets under management, why passive index funds give them massive voting power, and whether this concentration of corporate control is problem or efficient market function. Before we begin, a quick disclaimer. This content is for educational purposes only, not financial or investment advice. Company references are from public sources for educational commentary. Trademarks belong to their owners. Consult qualified financial advisors before making investment decisions. Here's how BlackRock became most powerful investor on earth. BlackRock was founded in 1988 by Larry Fink. Initially focused on fixed income and risk management, over decades they expanded into every asset class: stocks, bonds, real estate, commodities, private equity. Today they manage $10 trillion across all investment types. This makes BlackRock largest asset manager in world. The business model is asset management fees. BlackRock charges clients annual fees based on assets under management. Typical fee is 0.03 to 1% depending on investment type. Index funds charge lowest fees around 0.03%. Actively managed funds charge higher fees up to 1%. Even at low fee rates, $10 trillion in assets generates enormous revenue. BlackRock generated $20 billion in revenue in 2023. Operating margins around 40%. $8 billion in operating income. Most of that profit comes from scale. Once infrastructure is built, managing additional billions costs almost nothing. Software, research, and compliance expenses are fixed. Revenue scales with assets under management. The growth strategy is index funds. BlackRock's iShares ETF platform is largest ETF provider globally. Index funds track market indices like S&P 500. Investors buy shares. BlackRock buys underlying stocks proportionally. Low fees attract trillions from retail investors and institutions. As markets grow, BlackRock's assets grow automatically. This creates passive investing dominance. Investors don't pick stocks. They buy index tracking the entire market. BlackRock owns small percentage of every major company: Apple, Microsoft, Google, Amazon, Tesla, Meta, Nvidia. BlackRock is top 5 shareholder in nearly every S&P 500 company. Here's where voting power becomes critical. When you own shares, you have voting rights at annual shareholder meetings. You vote on board elections, executive compensation, mergers, major strategic decisions. But most investors don't vote. They delegate voting power to fund manager. When you invest in BlackRock Index Fund, BlackRock votes on your behalf. BlackRock votes at thousands of companies. They determine outcomes of board elections, approve or reject executive pay packages, influence environmental and social policies. One asset manager voting trillions of dollars worth of shares across entire economy. The counter-argument is BlackRock votes in shareholders' best interests. They analyze proposals, consider long-term value, vote to maximize returns. If they vote poorly, investors leave and assets decline. Market discipline keeps them aligned with shareholder interests. But BlackRock's interests and your interests diverge in subtle ways. BlackRock earns fees on assets under management regardless of performance. They prioritize asset growth over returns. Voting for ESG policies attracts ESG-focused investors, increasing assets. Whether those policies maximize shareholder value is debatable. BlackRock publicly supports environmental, social, and governance initiatives. They pressure companies to disclose climate risks, increase board diversity, improve labor practices. Critics argue this is political activism disguised as fiduciary duty. Shareholders invest for returns, not social engineering. Larry Fink's annual letters to CEOs outline BlackRock's priorities. Companies take these seriously because BlackRock controls huge voting blocks. If BlackRock votes against management, proposals fail. CEOs listen when largest shareholder speaks. The regulatory concern is concentration. BlackRock, Vanguard, and State Street collectively own 20% of every major corporation. 3 asset managers controlling massive voting power across entire economy. Some researchers argue this reduces competition. If same investors own competing companies, they have incentive to keep prices high rather than compete aggressively. For example, BlackRock owns shares in all major airlines. If airlines compete aggressively on price, profits decline, share prices fall, BlackRock's assets lose value. But if airlines avoid price wars and maintain high fares, profits stay high, share prices rise, BlackRock benefits. This creates perverse incentive against competition. Academic studies on this are mixed. Some find evidence of reduced competition in industries with high common ownership. Others find no effect. The question remains unresolved but concerning enough that antitrust regulators are investigating. BlackRock also provides investment advice to corporations through Aladdin platform. Aladdin is risk management software used by pension funds, sovereign wealth funds, and corporations globally. This creates potential conflicts. BlackRock advises companies on capital allocation while simultaneously voting as shareholder. Information advantages and dual roles raise conflict of interest questions. The bull case is BlackRock provides efficient capital allocation at scale. Index funds offer low-cost diversification to millions of investors. Passive investing democratizes wealth building. BlackRock's voting ensures corporate governance standards. Their size creates economies of scale benefiting investors through lower fees. The bear case is concentration of voting power in one entity is dangerous regardless of competence. BlackRock's influence over corporate America exceeds any government agency. They're unelected, unaccountable to public, driven by asset growth not public interest. When one firm votes at every major corporation, democracy and market competition both suffer. For individual investors, BlackRock funds offer excellent value. Low fees, broad diversification, solid performance. Whether you should care about their voting power depends on whether you think concentrated corporate control matters. Most investors don't. They want returns. BlackRock delivers returns. The broader implications are somebody else's problem. For society, BlackRock represents new form of power. Not government, not monopoly, but asset manager controlling enough shares across economy to influence behavior at scale. Whether that power is used responsibly or needs regulation is question policymakers haven't answered. The transparency problem makes oversight difficult. BlackRock's voting decisions are public but reasoning behind votes is opaque. They publish voting guidelines but application to specific situations is discretionary. Shareholders funding BlackRock's voting power have minimal input on how that power is exercised. Some investors want aggressive ESG voting. Others want pure financial focus. BlackRock tries to balance both and satisfies neither completely. This creates political pressure from all directions. Progressives say they don't do enough on climate. Conservatives say they're woke capitalists pushing social agendas. BlackRock maintains they're apolitical fiduciaries maximizing long-term value. The scale also creates systemic risk. BlackRock is too big to fail in financial system. If BlackRock's risk management fails or Aladdin software has critical error affecting trillions in assets, consequences ripple globally. Concentration of assets in one firm with centralized technology platform creates single points of failure. Regulators worry but haven't acted decisively. Breaking up BlackRock is politically challenging and practically difficult. Index funds are popular, effective, and benefit millions of savers. Restricting them seems anti-investor. But allowing unlimited concentration seems dangerous. The regulatory question remains unresolved. The uncomfortable truth is modern capitalism created entity with more influence over corporations than any government while maintaining its just passive investor following market. That's either efficient capital allocation or dangerous concentration depending on your perspective. Either way, $10 trillion votes and Larry Fink decides how. And that's how they built it. If this helped you understand business better, subscribe for weekly deep dives into the world's most successful companies. Thanks for watching.